Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 198 of the Independent Advisors Podcast, where Mark McEvily and I, Matt Jessup, bring you everything you need to know from the past week in the world of the financial markets and financial planning. This week, Mark is traveling, and in his spot is the one and only Nick Whitaker. He's our Director of Research and Trading. Welcome, Nick.
Always good to be here.
And big news for my Knicks last night. You want to tell all of our listeners what happened?
Oh, yeah. The New York Knicks closed it out against the Cleveland Cavaliers. 4-1.
Away game.
Away game at Cleveland.
Big statement.
Big statement. First time they've advanced to the second round of the playoffs in like a decade or something.
A decade.
I don't know the exact number, but it's a long time. So.
Now, I went to bed right after that, and we play the winner of the Milwaukee-Miami.
Okay, is that who you play next?
Yeah.
All right, so it'll be
and
Miami.
When I went to bed, Miami was up in the series 3-1.
Yeah, now they closed it out. Miami won in overtime.
They did?
They did.
I'm concerned about Jimmy Butler.
Yeah, Jimmy Butler's playing good. He scored 40 points again.
Oh, my goodness.
Yeah. So.
Now we got to shut him down.
Exciting stuff.
All right. Well, you want to dig in for us, Nick?
Yes. As always, we start with a little bit of pricing in the markets. So this data is coming from Y charts as of the market close on 4/26 yesterday. The S&P 500 is down 1.3% month to date and up 5.6% year to date. The Dow Jones Industrial Average is up 0.1% month to date and up 0.5% year to date. The NASDAQ Composite Index is down 3.0% month to date and up 13.3% year to date. The iShares Russell 2000 ETF, think small caps, is down 3.9% month to date and down 1.7% year to date. The Vanguard FTSE All World ex-US ETF is up 0.5% month to date and up 7.1% year to date. And checking in on the yields, 3-month Treasury rate is at 5.16, the 2-year Treasury rate is at 3.9, and the 10-year Treasury rate is at 3.43%. Lots of movement.
Seeing the farther end of that curve come in. Let's say about a week ago, that 10-year was a little bit over 3.5.
Mm-hmm. Lots of movement in the curve. The long end's coming in, and just a lot of fluctuation in the short end of the curve over the past couple of weeks, which we'll get into that a little bit.
Okay.
With our research, but jumping right into the big headlines and current events. We've got more than we usually have for you guys because it's been a busy couple of weeks and middle of earnings season. So we are in the heat of corporate earnings season. I will make one point on that, and that the majority of earnings, it's been more positive than the street has expected. We're going to get into some of those details later, but you have anything to add there?
No.
Okay. The other big piece of news that I'm sure a lot of people have seen on their whatever news sites they follow is news about First Republic falling 40% on Tuesday, or 49% on Tuesday. You can read all about it, and we'll give you the long and short of it right now, which is that they had a really rough earnings call and a really rough earnings release. The biggest part for me was the sentiment around the earnings call.
Yep.
The call lasted about 12, 13 minutes.
When's the last time you've seen an earnings call last 13 minutes?
I've never seen an earnings call last that long, except in a company maybe that is going bankrupt. So it's...
I don't mean to laugh, but it's just like almost unheard of.
Exactly. And so, like, just listeners seeing you laugh about that shows you just how drastic that is. They came on, they're basically like give a quick blueprint of the plan.
Run away in the shadows again.
And they didn't allow questions for earnings.
Oh, that's a disaster there.
They didn't take questions, and here's kind of the final straw is they withdrew all guidance. Oh. So, I mean, listeners, if you're looking on YouTube, you can see Matt's reaction. And that's the reaction of everyone on the street. It's basically whenever a company does something like that, and especially all three at the same time, you're going to get a very drastic reaction in the market because it's a total close off of transparency It doesn't give anyone confidence. The sell side are the researchers who write reports on stocks. I know we've talked about that in the past, but the sell side is obviously pretty upset because they like to ask questions at the end of the call for their model so that they can
absolutely
write research reports and upgrades,
get a check
downgrades
on the first 24, 25 days
exactly.
of the quarter.
Yep. And so because the sell side couldn't ask questions, a number of them suspended coverage.
As I think they should.
And then a handful of them also went ahead and just downgraded them to sell. So they also came out a little later that day, and there was news about the company, about First Republic divesting $50 billion to $100 billion of long-dated mortgages and securities, just in a bid to further strengthen their balance sheet. Not surprising, given some of the givens, but it's just the news cycle of all of that. Given everything that's going on, you would think they would really stick in and have it just a terrible call and just take the questions.
Oh yeah, a 2-hour call, 3-hour call. Hey, next question.
Right.
Yeah.
But they didn't. So that's in my opinion, that's one of the big catalysts for why you're seeing that in the news. It's a lot of those intangible sentiment feels. And for people who don't know, the average earning call, it floats around about an hour.
Mm-hmm, yeah.
That's pretty normal, but they can go much longer.
Sure.
A lot of the street doesn't like it when they go longer because we've got to be on a lot of earnings calls. So,
sure.
But the standard is an hour.
Yeah. Well, I mean, my last comment on this topic is it's almost like we're starting to slowly rehash the banking crisis we had in March.
Right. Exactly.
And so people are now reevaluating other names that, okay, well, if First Republic's having these types of problems, who else might be having these problems still, blah, 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 blah.
Yeah, it puts a lot of stress still on regional banking, and which is kind of bleeding into to some of the small cap.
Yeah, and we got to remember that financials make up over 20% of the small cap index, like the Russell 2000. I want to say it's like 22% is financials. And so that's definitely something that weighs on that index.
Yeah, and so going back to our numbers from the beginning of the podcast, that ETF that you just mentioned, the Russell 2000, is down 1.7% year to date.
Yeah, that's
relative to market averages, and I guess you could call it an average of like 8, maybe.
Yeah,
7.
Interesting.
And the last little bit I have on the news front is some economic news. Orders for durable goods came in on Wednesday, yesterday. Orders were up a robust 3.2% month over month. Most of that was powered by a noticeably large increase in new orders for non-defense aircraft and parts. Excluding transportation, durable goods only rose 0.3%. The key takeaway here being that non-defense capital goods orders, excluding aircraft, which is a proxy for business spending, declined 0.4% in March. So, the headline number is going to read a little different than when you kind of peel back the layer. So kind of that middling, not amazing economic news, probably what we want, to be honest.
Yeah, I'll take that. Definitely take that.
Pretty healthy, but not deteriorating, coming down a little bit.
I could probably answer why the non-defense aircraft and parts were up so much is, these birds were flying so hard right after the pandemic as everyone wanted to travel.
Yeah.
And, it's just like you have a car that has you drive it so often you have to get an oil change. They have to do overhaul on these planes. And I think it's just they're at their point where, okay, seasonality, they got to start doing some maintenance on these planes.
Yeah, I was about to say it's March. They need to make sure they're ready for the summer travel.
Yep.
So,
U.S.
GDP growth rate came out this morning at 1.1%. The consensus was 2%.
That helps the Fed?
That helps. When you say helps the Fed, can you explain that for listeners?
So it helps the Fed not to have pressure to continue to raise interest rates. Because right now, before this release, tongue-in-cheek, the market was given about Vegas odds of about 75% that they're going to have one last rate cut of 0.25% on the May 3rd meeting. And when this economic data comes in light, it says that the medicine, these raising interest rates the Fed has been doing, is working. And they might not have to continue to pump medicine, i.e. an interest rate hike, at the May 3rd meeting.
Yeah.
And if I were a guessing man, I'd say those stats those Vegas odds might come down to like 50 or 60% after a print like that.
Yeah, it'll be interesting. There'll be a lot of movement in that tomorrow morning. That's the last piece I have. It's just an FYI for listeners that the PCE price index, that's the Federal Reserve's preferred measure of inflation.
Personal consumption expenditures.
Yes. So think inflation, similar to CPI, but it's just a different metric, and the Fed likes that metric a lot. So that's coming out tomorrow morning. That will be very, very hotly watched.
And I will note for our listeners and viewers that a month ago when this piece of data came out, it was the first time in over a year where the Fed funds rate was a higher number than the PCE inflation rate.
Interesting.
Which gives more credence that a potential pause on May 3rd could happen.
Yeah.
And if it did happen, I'm going to speculate that would be a positive for risk assets like equities.
Yes. Yeah, I would think what the market wants tomorrow to have a positive reaction is to just see that trend continue.
Lower on inflation.
Let's see inflation come down a little bit. It doesn't need to drop, but even if it's relatively flat, I think the market will handle that okay. But if it were to spike, then you're going to see some movements in the market.
Yep.
I'm not going to tell you what I think is going to happen. We'll see.
I'll say something. I think it's going to come in lower than month 4.
Yeah, I think I would. If I had to guess, I would say it'll be a couple, tenths of a percentage lower. Nothing crazy, but I think
I'll take whatever it'll give me.
Lower. Yeah. Which leads us into our tweets, articles, and research this week. And I'm going to start off by there's been a lot of headlines that I've seen on Bloomberg and some other news sources about hedge funds being short different parts of the market, and I'm sure some listeners have either heard of that or seen something on their news channel. So this first piece I have is it's an article from Bloomberg on the 24th, and it says hedge funds placed biggest ever short on benchmark Treasuries. And there's a chart, and we'll throw the chart up here. And I have 2 research pieces back to back here that are kind of going to debunk a lot of the stuff that you may be seeing, or hopefully give you a little bit more clearer understanding on what's going on here. But this chart just shows the leveraged funds net long-short positions on the 10-year Treasury futures. So it's basically shorting the futures market. So shorting is you're betting that prices are going to go lower. And there's multiple ways you can look at this. And what the article points out is, in part, this is hedge funds, which in the market think speculators, think fast money, think guys that are moving in and out of positions.
They're not worried about where the market's going to be a year from now. They're worried about where the market's going to be a week from now.
Right. Your hedge funds, that type of investor is going to be associated with a term you'll hear called market neutral. It's guys who are shorting and going long at times, and they hedge out their positions. So they're the speculators in the market, very aggressive investments, and a lot of times that's why you see hedge funds blow up after a year or 2. And when I say blow up, I mean dissipate.
Yes.
So one of the takeaways from this is that hedge funds may be thinking inflation will be stickier than the market is currently expected. So that's one potential possibility. But the other thing I'll point out is that these markets are really complicated, and they're kind of dark markets. They're difficult to track and truly understand what's going on. That's very important to point out to listeners, is that these swap markets, these shorting on futures, the data is not perfect. You don't know exactly just this chart doesn't tell me if hedge funds are really that bearish on treasuries, because you don't know what else they're doing in their book. It could just be a hedge strategically to help them get a more stable return. So
interesting.
One of the things the article pointed out is that these short positions could be exaggerated by the revival of so-called basis trades, which is when hedge funds buy cash treasuries and short the underlying futures.
So in essence, they buy the physical treasury security and then short,
Short
on
the
paper
long end.
on the futures market.
Yeah, short the long end. And it's really like an arbitrage trade where you're not making a lot, you're making a couple basis points. So they pointed that out at the very bottom of the article, and it made me kind of chuckle because I'm thinking that could definitely be going on. They also say the trade involves buying bonds that have become cheap relative to the underlying futures and then selling the futures to pocket the difference. The profit is usually small, hence the tendency to use leverage. And if you recall at the beginning of this chart is leveraged funds are net short on the 10-year Treasury.
Interesting. So, the way I kind of relate this, bring it back, if people are thinking we're going to have a sluggish economy in the second half of the year, typically when you have a slowdown, and I'm not inciting that we're going to have a technical recession. Let's just say we have a slowdown in the economic data. In those types of environments, historically, interest rates come down. Interest rates come down from a supply and demand metric, right? You have money flow into safe havens, lowers their yields.
Yep.
And so I'll be curious to see the second half of this year if inflation continues to come in, providing cover for the Fed to lower interest rates to spur economic growth in the light of a sluggish economy. That, once again, and I'll say it again, that's going to be the focus of the market the second half of the year, is no matter what the Fed does on May 3rd, they raise or they pause. Second half of the year is how long do they pause before they start to lower?
Yeah. When can we start to cycle lower?
Yep.
Yeah. That leads me into my second piece, which is related to a lot of what we're talking about with some of the hedge fund headlines. And this provides, I think, a very clear picture. Okay. And it's a tweet from also on the 24th from Markets and Mayhem. Note the dates are the same on the 24th with the headlines and everything I was mentioning. And Markets and Mayhem says the following: could we stop saying hedge funds are massively short now? ? They're net long. And this is a chart. The source is Goldman Sachs, and we'll throw this chart up as well. Yep. And you can see the trading flows of long, short, and then the net flow. And again, this comes from Goldman Sachs. I could spend a lot of time talking about how they get this data, but I won't, so as to not bore listeners, but it's good data. Goldman Sachs.
If you're ever interested, reach out to Nick. He can explain this stuff to you.
Yes. Goldman Sachs has, this is the research hub that I'd want to see the data from. I'll put it that way.
Yes.
I trust them the most when it comes to hedge fund data. And so you can see here that this black line is what we care about, and that's where you can see that net flow, just meaning that they're more exposed to the long side, the buy side of the market.
Which means they make money when stocks go up in value.
Exactly. And going back to what I was saying about these types of investors, they're doing really complicated, often overcomplicated strategies, and so that's what that means. Net flow.
That's an interesting piece of data to me.
Yeah. Especially just combined with some of the headlines, because it piqued my interest, and so I wanted to clear that up for listeners. Do you have any other thoughts on that one?
No, I think that there's still just a lot of pessimism in the markets, and I go back to what I've said in the last couple of podcasts. We've had a lot of sideways chop. Mark was talking about that recently, but just the overall resiliency in the face of bad news flow is a very telling piece of data to me.
Absolutely.
And so to say it very now plain for our average listener, you got a lot of bad news coming out, and historically the market would move lower on that type of news, and you got this kind of sideways movement. That to me is very telling.
Absolutely. A great example is the First Republic that we talked about.
People were really concerned about the stability of the financial system. That would tend to be a worrisome piece of data, right?
Yeah.
But it kind of caused just sideways chop in the market.
Yeah.
It's just interesting.
And this latest news with First Republic, don't get me wrong, First Republic fell 49%, but the market didn't freak out.
Yeah.
And the market was relatively stable, which is great.
Interesting.
So the next two pieces I have for you guys is what we want to talk about, which is corporate earnings.
I love corporate earnings season.
Yes. So this first one is it's a tweet. This is actually from the 18th, so a little bit old, but still very good data. It's from Jurian Timmer. He's the director of global macro at Fidelity. He says the following: corporate earnings are declining from a year ago, but the same cannot be said, in parentheses, yet, for revenues, which continue to stair-step higher, at least in nominal terms. So far, this has been the appearance of a soft landing. And there's a really cool chart, and Mr. Timmer loves these really wild and complicated charts, but when you look at them pretty closely, they're pretty neat. And what I really want to focus on is just the main piece here, which is the S&P 500 revenue per share and the trend. And I don't know what you think about this, but I think that looks pretty interesting to me.
First of all, just to kind of reiterate, the definition of a soft landing is where the Fed is able to raise interest rates at the pace and the amount that they did and not cause a technical recession, right?
Not cause a ton of pain to the economy.
Yes. And I think that the market, for the most part, has been ignoring the fundamentals for well over a year. Mm-hmm. Because the market has been thinking, there's no way that the Fed can raise interest rates without causing a recession. Boom, let's sell off stocks because earnings have to get hit hard.
Yeah.
And guess what's happened? They haven't.
They've not been hit. They've come down, as we would expect, but not
nowhere near where their stock prices are at.
Right, exactly.
It's just there's a difference of two worlds there.
Yep. So the revenues look good there. We'll see what happens as we kind of go through the earnings season. We're in the peak of it right now, which leads me into my next piece, which is from a tweet from yesterday, actually, from Matthew Miskin. He's the CFA. He's a co-chief of investment strategist at JH Investments, and he says S&P 500 earnings season is going well with an 80% beat rate thus far.
Can you say that again, please?
An 80% beat rate thus far for Q1, with just over 30% of companies reporting. Year-over-year growth rate negative 0.05%. Estimates for 2023 overall is 0.86%. And then there's a table here that we'll throw up for listeners. And this isn't a super easy to digest table, I understand that, but I'm going to push you guys to look at the beat rate in column 5, and you can see this is the beat rate, meaning the street is saying we expect earnings to be at X, and the earnings comes in at Y above the consensus expectations.
Very interesting. And roughly a third have reported so far, roughly?
Roughly, yeah. But also it's important to point out that a lot of big names report earlier in the cycle. Now we're going to get into the heat of it over the next couple of weeks, but think about banks, right?
Yeah.
That's one of the first ones I'd point out.
Healthcare and banks are usually the first couple sectors.
And the financials beat rate was 62%, which is interesting. And we could dive deep into the estimates on the other columns, but I'll just let listeners look at that, and it's pretty easy to kind of deduce what's going on there. What are your thoughts here?
I think that the market is focused on the headlines and it is not focused on fundamentals right now. And the market has been this way now for well over a year. And at a certain point, let's say that we have the peak in this interest rate cycle sometime later this year, and let's assume interest rates start to come down. This money is going to have to find a home to seek a return. Mm-hmm. And guess what's going to come back into the fold? Fundamentals.
Yep. And
the fundamentals, the underlying financials of these companies, in my opinion, for the most part, they're not bad.
Yeah, I agree, which is one of the interesting things we've seen over the past week with the chop and some of the tepidness, the low volumes, some of this, you can almost sense the market doesn't want to move yet. They want to get through some of these earnings. And really
see what the Fed does on May 3rd.
Yeah, you got the inflation number tomorrow. There's just enough to where the market's just kind of digesting.
I'm okay with that.
Yeah, I think I'm
okay with that.
That's healthy.
All right, ready for my piece here?
I'm ready for it.
My first piece is going to be a look at the American consumer, okay? There's a lot of talk right now, Nick, about what's going on with the American consumer right now. What do they look like financially? So I saw this tweet by Carl Cantanilla on April 20th, and he was referencing a chart from Apollo Group, which is a big private equity firm. Okay, you're familiar with Apollo.
Yep.
I'm going to read the quote to you first, and then I'm going to talk about the chart. The quote is, U.S. households are in excellent shape. And I'm reading this verbatim. Household leverage is currently at levels last seen in the early 1980s. If the unemployment rate rises, consumer spending will slow down, but the starting point for U.S. households is very strong, end quote. Now, Jenna's going to put this chart up for our YouTube viewers. The chart will also be available in our show notes and our various social media sites on Twitter and Facebook and LinkedIn, etc. This is a chart that shows U.S. household balance sheets, and it looks at household leverage, the ratio of liabilities to net worth, okay? The ratio of liabilities to net worth. And what's just very interesting to me is I'm not getting the feeling that households are over-levered. Now, you are starting to see the creep of a lot of this, wow, you're seeing all this credit card balances go up. Yeah, you're coming off such a low base during the pandemic. No one was spending money. They were paying off their credit cards at that time. Mm-hmm. You give me that chart over a 20-year period, then we'll talk.
Right.
But it's like when I look at this, I don't want to overplay this, but the American consumer, in my opinion, is okay. I'm not going to sit there and say they're in excellent shape. They're okay. This is not in the category of I'm concerned right now. That's just my 2 cents. Anything you want to add?
I agree. The one caveat I would have looking at the chart and thinking about the data that's behind it is the increase in housing prices over the past 5 years will inflate the safety ratio of this chart, if that makes sense.
Yeah, that's what you're saying is the equity that people have seen rise in their homes, especially over the last decade, right, has raised their net worth.
Right, raises the net worth and makes that leverage ratio look better.
Sure.
However, at the same time, you could make the argument that doesn't really matter because they could still sell their house for that price.
Yeah.
Right? So that's kind of where it's like,
it's
a lot of this I think could be like the past few years, you could have some of that going on. So where I would get concerned with that is if, we had like another crazy drop in the housing market. Yep. Right. That's where I think you'd see that pop up, but I'm not really expecting that type of action in the housing market personally.
Well, I'll throw this out there. A year ago, I think that there was a feeling that there would be more pain than we've seen over the past 12 months in housing. I would argue that point right now.
We were talking about it a lot, and I think the three of us were saying the same thing, where we were like, yeah, we think it'll come down, but we're not expecting a crash.
And that's exactly, it just kind of just leveled off.
Exactly. It's leveled off. It's come down a little bit, but not drastically.
So my next piece is an interesting tweet by Charlie Bilello on April 18th. This one is going to get me going. Okay. This is a chart that he's posted. It shows S&P 500 index forward total returns following a CNBC Markets in Turmoil special. Okay? So for those of you that are not watching on YouTube, I wish you could have seen Nick's face there a couple seconds ago. Well, what happens, listeners and viewers, is when there is times of market stress, financial news networks, they pounce on the opportunity to, hold a special so they can get more experts, quote unquote, to come on and to, talk about the markets. Very common, right? But these things tend to occur at points of kind of peak market stress or around the points of peak market stress, okay? So this chart will go back all the way. Its first data point, Nick, is May 6th of 2010, okay? And the last data point on this is May 5th of 2022, okay? And I want you to look at the bottom of that chart for our listeners, and I want you to tell me what is the average one-year return for the S&P 500 index after one of these specials And how many times, what percentage of the time is it positive?
So the average 1 year return after one of these specials is 40%.
40?
40% is an average 1 year return, and there has been a perfect 100% positive return ratio.
And how many data sets you see here? Just ballpark it for me.
There's a lot.
50? 60?
There's a lot. Yeah, I don't know. Yeah. 60,
So
yeah,
I
50.
find it interesting, and here's why I want to make this relational to our listeners, okay? There will continue to be, over the coming decades, periods of market stress. The data flow and the news flow at times will be very concerning. And the thoughts will be, oh, it's really different this time. It's going to take the markets could go drastically lower. And are those things accurate in the short term? Absolutely. But the argument that I'm making, Nick, is that for a majority of those listening to this podcast, this money is invested for the long term.
Absolutely.
And I do not want people changing their plan, thinking they could get out, time to get back in, because when you look at a normal calendar year, and this is not an exaggeration, you miss 10 of the best days, there's a good chance you could have a negative return that year.
Yeah.
And I just want to throw that out there that, when you see these, points of market stress, and I will try to recall this chart the next time we have a CNBC Markets in Turmoil special. And I'm not trying to dog CNBC. Bloomberg probably has the same thing. Fox Business probably has the same thing. This is not just a CNBC situation. It's just, we got to realize that looking out farther, extending that time horizon, things probably aren't as bad as it seems.
Yeah.
Everyone thought earnings would have cratered a year ago, and they really haven't.
That was the call at one point.
So here's my next piece, okay? This is my last piece. This is a piece from Citi Research. So Citigroup Research note regarding the global economy. So this was a tweet by Walter Bloomberg on April 19th. He's a trader I follow on Twitter. Guy's got like 650,000 followers, okay? So this was the tweet. Again, global economy to expand more than expected this year, says Citigroup. Quote, the world's economy is expected to expand 2.4% this year. That's 0.25% more than previously anticipated, as the effects from the banking sector turmoil continue to recede. Economists at Citi say in a note, the revision reflects a solid performance in the U.S., the Eurozone, and China, they say. Still, global growth will be below trend as central banks tighten policy to tame inflation. This is what Citi says. For 2024, the U.S. Bank expects the global economy to grow 2.1%, lower than the 2.5% previously anticipated, as both the U.S. and Eurozone economies feel the drag of higher interest rates. While the acute phase of the banking tensions appear to be abating, we continue to see chronic challenges associated with higher interest rates, says Citi. So your initial thoughts when you see a note such as this, very big picture, global economy, a lot of cross currents, but still positive growth.
I think it's my initial response is that it's positive. My initial response is positive. My first thought was, I wonder what the IMF data says. That's my first thought, because wasn't like 3-4 months ago didn't the IMF come out and slash global growth down to like the 1% or something? So I wonder where their forecast is what's going on in the back of my head right now. But generally speaking, no, that's great. 2% is good.
What also made me think of this is when you think of our big banks here in the U.S., I'm talking the big boys. I'm talking like JP, Bank of America, Citi, Wells, etc. I could argue that Citi has a disproportional amount of international exposure compared to the others.
Oh, absolutely. Absolutely.
So when I see notes from them about the global economy, I perk up a little bit more, okay? Because of the disproportionate exposure they have internationally outside of the U.S.
Right.
So I think that it makes me think, in my opinion, all right, they got a little bit of a better read-through on the global economy and some of the others.
Yes, I absolutely agree with that.
So it's just interesting because I think if we were to poll people And with sentiment is the way it is, I think people would assume that the global economy is in a little bit worse position than some people who are in the weeds are telling us right now.
Yeah, I agree. I think, and we've seen that too recently with consumer confidence numbers ticking a little lower, and then the BOFA fund manager survey a couple weeks ago. Is that right? You guys talked about that on the podcast, I think. Still a lot of negativity in that as well. So it's interesting. It's a good point about Citi and having the more exposure to the international audience, and for listeners who are wondering why that's important or why we can think about that, it's why we would trust the data more from a Citigroup relative to a JP Morgan. It's because they have
real time data,
and it's private. Like, they have more customers.
Yes,
they understand their customers better. You have to understand your customers. They're your customers, so you have real hard data, like direct access
real
to
time
data.
hard data, money flowing, money being borrowed, how it's getting invested.
Right. And I can speak from an analytics perspective, and having worked in and with a lot of red tape on, we had private insider information, but you can still take that information, and as long as you paint it vague enough, you can still use that information and come up with a number like this. And that's how they do that. Yeah, that's why it's so interesting.
Absolutely. It's like, JP Morgan does a really good job with this because they have a good, I think, diverse exposure to the U.S. in general. They're not just centric on like the Southeast, or they have their exposure in the West.
Right.
And so when you hear comments from Jamie Dimon saying, hey, this is our read through on the American consumer, it's very similar to what you're kind of mentioning. Is they're not calling out any specific, individuals or divulging that private data, but they're making a blanket statement that, hey, the American consumer, and I'm just going to give a fictitious example, is a lot better than people think. They're spending money, they have good balances, et cetera.
Exactly. And they can see that with real-time hard data. So it's interesting.
Why don't you just for people that are newer to you, Nick, why don't you just take 30, 60 seconds and tell them what you used to do in your former professional life?
Oh, sure. There's a podcast. I think the first podcast we did that on, where it was quite more in depth. But prior to joining Jessup Wealth Management, I spent about 7 years in the stock surveillance industry. It's really like peeking behind the curtain of Wall Street. And in a nutshell, what I did was I helped publicly traded companies understand who their shareholders were and whether or not their shareholders were buying and selling the stock. So I was an insider on behalf of publicly traded companies. It was an institutional consulting role. It's data analytics, following the markets, it's consulting, et cetera. So I would talk with the C-suite or the investor relations officers of these companies. And I worked in real estate and energy, were the two teams I was on across those 7 years. But that's one of the reasons I have some of the experience with thinking about the data analytics.
Absolutely.
Spent a lot of time doing that, and really saw how money moves. It's a very unique position, a very unique industry, because you get to see how money moves behind an individual name. So, Apple or pick a name. If you're the analyst on that account, you track the data using every type of resource you can get, publicly traded filings, you get a weekly inflow of custodial data, so where those shares are held, and then the company over time has been able to map that with fund disclosures and things of that nature.
Sure.
Contacts at back offices.
Talk about data mining at its best.
It is data mining. It's data mining and analytics, and then really getting to understand quant money and how quant money moves. And if you recall, like 2018, you remember December.
I hate the fourth quarter of 18. I still have nightmares about it.
Yeah. So,
Jenna, how many times do I quote fourth quarter of 2018 in this podcast? That was a tough quarter.
Yeah. So, and what I can tell you is it was really interesting working in that field at that time, because you have your clients calling you and saying, "What is going on? Like, what is going on?" And I'm looking at the data. 9
months of gains given up in 3 months.
Yeah, and I'm looking at the data and I'm telling them, none of your big shareholders are moving. To me, this looks like some type of weird, blown out quant trade.
Yes,
which is what it. Enough news came out, and that's the data that. And honestly, at that time, like we are the best
blew
people.
Up domino effect.
Yeah, at that time, the stock surveillance people are the best people to answer that question.
Oh yeah,
and that's what we were all seeing across
all
sectors. And you could just tell with the data where it's really like noisy and like it's just bad data, and that's really only driven by high frequency trading and quant shops. So anyway, that's what I did.
That was great. I just appreciate just for some of our newer listeners, I thought it was great that you just kind of re-explained that.
Yeah, sure.
So before we kind of finish up for the week, we're going to skip the financial planning topic of the week since you and I went in the weeds on some research items. Anything you want to leave our listeners with, Nick?
No, thanks for having me. I guess the one thing I will leave listeners, which you hit on it a little bit with the markets in turmoil, is take a few deep breaths. And the market's choppy, but this stuff is normal. And don't shy away from your long-term plan.
You have a proper long-term time horizon on this.
With your financial advisor. So.
And I'll add one last piece just to build on that. This year definitely feels like one of those years where it's time in the market, not timing. And it feels like we're going to have a half a dozen or so between now and the end of the year days that really make up a majority of this year's returns. It's just a feeling. It's my years of experience saying this. So this is a market where at times it might get frustrating. You look at the tape or the way the market's traded in April, frustrating month.
Very much,
but man, you could have 1 or 2 days and make all that up like that.
Yeah.
And so it just feels like that type of year.
Yeah.
So that's where we'll leave it. So we'll be back next week for another episode of the Independent Advisors Podcast. Thank you for listening to episode 198. And myself, Nick, Jenna, Mark, Aaron, Taylor, thank you for listening.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.